How much is a company worth? It sounds like a simple question, but valuation is one of the most complex and consequential skills in all of finance. Whether you're buying a stock, acquiring a business, or raising capital, everything starts with valuation. In this video, we break down every major method professionals use. Valuation is not a science, it's an art informed by data. There is no single correct answer. Two highly skilled analysts can look at the same company and arrive at different values. What matters is your ability to triangulate across multiple methods and defend your assumptions. The most fundamental concept in valuation is intrinsic value, the present value of all future cash flows a business will generate over its lifetime. This is the theoretical floor. Everything else, market value, transaction prices, comparable multiples, is some variation of how the market perceives that intrinsic value. The first and most rigorous valuation method is the discounted cash flow analysis, or DCF. A DCF projects a company's free cash flow into the future, typically 5 to 10 years, and then discounts those cash flows back to today using a required rate of return called the weighted average cost of capital, or WACC. Free cash flow is defined as operating cash flow minus capital expenditures. It represents the cash the business generates that's available to all capital providers, both debt and equity holders. The higher and more predictable the free cash flow, the higher the intrinsic value. WACC reflects the blended cost of all capital, equity and debt, weighted by their proportions in the capital structure. Equity is expensive because equity holders bear more risk. Debt is cheaper because it's tax-deductible and lenders have priority. A typical WACC for a mid-size company might be 8 to 12%. After projecting cash flows for 5 to 10 years, analysts calculate a terminal value, which captures all value beyond the projection period. There are two methods, the Gordon growth model, which assumes cash flows grow at a constant rate forever, and the exit multiple method, which applies a multiple to the final year's EBITDA. A key sensitivity in every DCF is how much of the total value comes from the terminal value. In many DCFs, 60 to 80% of total value comes from terminal value. This means small changes in the assumed long-term growth rate or exit multiple can dramatically change your output. Stress test these assumptions. The output of a DCF is an enterprise value, the value of the entire business including debt. To get to equity value, you subtract net debt, total debt minus cash, from enterprise value. Dividing equity value by diluted shares outstanding gives you an implied price per share. Despite its rigor, the DCF has limitations. It's highly sensitive to assumptions. Garbage in, garbage out. Small changes in WACC or growth rates produce huge swings in value. For early-stage companies with no cash flow, a traditional DCF is nearly useless. This is where relative valuation becomes critical. Comparable company analysis, or comps, is the most widely used valuation method on Wall Street. The idea is simple: if similar public companies trade at certain multiples, your company should be worth a similar multiple. You're letting the market define value rather than building your own assumptions. To run a comps analysis, you identify a set of publicly traded companies similar to your target in terms of industry, size, growth profile, and profitability. You then calculate valuation multiples for each company, typically EV/EBITDA, EV/revenue, and price to earnings. EV/EBITDA is the most common multiple in M&A and PE. It measures enterprise value relative to operating profitability before non-cash and financing charges. A company trading at 10x EBITDA with $20 million in EBITDA has an enterprise value of roughly $200 million. EV/revenue multiples are used for high-growth companies that are not yet profitable, like SaaS or biotech firms. A software company growing at 30% might trade at 8 to 15x revenue. A mature industrial company might trade at 1 to 2x revenue. Growth is the key driver of revenue multiples. Price to earnings, or PE, is the most well-known multiple in public equity markets. It measures how much investors pay per dollar of net income. Growth companies with strong outlooks command high PE multiples. Value stocks with slower growth trade at lower multiples. The S&P 500 historically trades around 15 to 20x earnings. When building a comps table, you spread the multiples across your set of comparable companies and calculate a median and mean. You then apply those multiples to your target company's financials to arrive at an implied valuation range. Always present a range, never a point estimate. Precedent transaction analysis works similarly to comps, but instead of looking at public market trading prices, you look at prices paid in prior M&A deals for similar companies. Transaction multiples are almost always higher than trading multiples, because buyers must pay a control premium to convince sellers to sell. The control premium, typically 20 to 40% above the public trading price, compensates shareholders for giving up their equity. In private transactions, this premium is embedded in the deal price. When you see a company get acquired at a significant premium to its stock price, that's the control premium at work. Precedent transactions are pulled from databases like Bloomberg, FactSet, or PitchBook. Analysts look for deals in the same industry over the past 5 to 10 years. The further back you go, the less relevant the data, market conditions and multiples change significantly over time. The LBO analysis is both a valuation method and a return analysis. In an LBO, the maximum price a PE firm can pay is determined by the returns they need to generate. Working backwards from a required 20% IRR and an assumed exit multiple, they calculate what entry price they can afford. LBO valuation sets what's called a floor valuation, the minimum price the company should be worth in a financial buyer's hands. If a strategic buyer can generate synergies from an acquisition, they can often pay more than a PE firm. This is why strategics often win competitive M&A auctions. Sum of the parts valuation is used when a company operates multiple distinct business segments. Instead of valuing the whole company, you value each segment separately using the most appropriate method for that business, then add them together. The total often reveals hidden value or a conglomerate discount. Asset-based valuation is most relevant for holding companies, real estate firms, or businesses in distress. Instead of valuing cash flows, you assess the market value of all assets on the balance sheet and subtract liabilities. This gives you net asset value, or NAV. It's rarely the right method for operating businesses. Liquidation value is the lowest valuation floor, what you'd get if you sold all the company's assets immediately in a forced sale. Assets are discounted heavily from book value. This is used in bankruptcy and restructuring contexts, not in normal M&A transactions. For startups and early-stage companies, traditional methods often don't apply. Venture capitalists use the venture capital method, projecting an exit value in 5 to 7 years, applying a target return multiple, and working backwards to determine how much the company is worth today. The football field chart is how Wall Street presents valuation in pitch books and fairness opinions. It shows the valuation range implied by each method, DCF, comps, precedents, LBO, as horizontal bars. The overlap of these ranges is where the most defensible valuation sits. A common mistake junior analysts make is anchoring too heavily on one method. No single method is correct. The DCF captures intrinsic value but is assumption-heavy. Comps capture market reality but can be distorted by irrational market sentiment. Precedents capture deal prices but may be outdated. Use all three. Market sentiment matters more than most people admit. During a bull market, companies trade at premium multiples, sometimes disconnected from fundamentals. During recessions, multiples compress. Timing your valuation analysis matters. A company worth 20x EBITDA in 2021 might trade at 12x in 2023. Valuation is ultimately a negotiation tool. Sellers want a higher valuation. Buyers want a lower one. Investment bankers running sell-side processes use valuation to maximize price. Buy-side advisors use valuation to discipline their clients from overpaying. Both sides build models, and argue about assumptions. The best finance professionals don't just build models, they understand what drives value in a business. Revenue growth, margin improvement, capital efficiency, competitive moat, management quality, these qualitative factors get translated into numbers. Valuation is the bridge between a business story and a price.